this work? Okay, yeah. I'm Conrad Everhard. As Marty pointed out, I'm a partner at VLP Law Group. I'm a corporate M&A and merger and acquisition and transactional partner. I've been practicing for over 20 years. I was formerly a big firm partner at Jones Day, Brian Cave, among others. For several years before I joined VLP, I was GC and Vice President of AE Polysilicon, which was a high-flying solar startup, so the early 2010s. We raised an awful lot of money, and we spent an awful lot of money. The company went down during the market downturn in 2012, and I was involved in selling the company and its assets primarily to Chinese buyers. Since that time, I've returned and I'm practicing law again on the corporate side with a technology bias at VLP.
My name is Todd Feldman. I'm a managing director at Mooreland Partners. I've been in technology, finance, and in banking for about 20 years. Started off at a bulge bracket, DLJ, was on the operating side for a couple of years, and then joined Mooreland when it was founded about 13 years ago. At Mooreland, I do a lot of our work globally in communications, mobility, and also digital media. Mooreland is now about 13 years old. We currently have 50 bankers worldwide, 3 primary offices here in New York, London, as well as Silicon Valley. We do about 25 transactions per year, and about 50% of our business originates out of Europe. So it's about 50-50 US and Europe.
Hi, my name is Ben Boissevain. I'm with Bois Capital, and we are a boutique investing bank, just like Todd, a little smaller actually. We focus a lot on cross-border as well. We've got a sell side in Scotland, sell side in Israel, sell side in Paris, a buy side in Spain, and then 4 domestic clients right now as an example. And it's very technology-oriented, that's all we do. And within that, we have specialties in analytics as well as digital media.
Okay, thanks. And so to get things started, I'd love to hear a little bit about your perspective on the current state of the market, with maybe a particular focus on what's going on here in the New York City metro area. What sectors are being active, what sectors are not so active. Ben, would you like to get us started?
Sure, yeah. So I think in New York, ad tech is definitely down at this point. It was a hot sector for a while, and digital media is still very hot. It's a great sector. And within that, there's SaaS software as well. What I find interesting is that, there's definitely a bubble going on, but ad tech's a good example, because hopefully it's deflating slowly, not going to burst all at once.
So, I think in terms of New York, we would agree it's certainly heavy in digital media, ad tech being one, marketing technology being still another sector of interest. Financial technology, or fintech, is also a real focus here in New York. In terms of the overall market, and we were discussing a little bit today, I think if you go back a couple of months ago, and 2015 across the board in terms of M&A has really been record years in a very robust environment. We are starting to see that soften, really starting at the top. Even today, many of you might have seen the news in terms of the leverage markets are starting to slow down. We've all seen, I think, some of the IPO markets, and a company like Square that is set to go public is actually bringing down their valuation. So I think there are some headwinds that the market's facing as we go into 2016, and that is coming off of a very robust 2015.
Okay, great. So Todd, you touched on valuation, so let's maybe kind of dive deeper into that. And if you could talk a little bit about what entities should expect prospective buyers to be thinking about in terms of key metrics, projected revenue, growth, projected cash flow in the environment that you described.
So each market, each segment of the market is very, very different and will warrant different types of multiples. Both Ben and I work largely in the technology sector, or actually solely in the technology sector. So certainly revenue would be the primary metric that we look at and our buyers look at. So multiples of revenue. There are segments of the market that we touched on in terms of SaaS or marketing technologies where you would look at a run rate or an annual recurring rate But again, mostly focused around revenue, less on the profitability today.
Yeah, I would agree with that. I think revenue is the key metric, but we are seeing a little shift. We have a company we're marketing right now to big strategic buyers, and a couple of weeks ago, we only buy profitable companies now, which is a big shift. They want it to be accretive to earnings, and so I think the days of revenue only still there, but it's interesting to see that. And then on the flip side, we're seeing private equity firms that typically have a $5 million EBITDA minimum, and they're willing to waive that and take loss-making companies. So that's a real flip in the market, which is interesting.
So where the key metric is revenue or something other than cash flow, is there a discussion that needs to be had about how does the company eventually turn those metrics into cash flow? How does that work?
Well, I'll give you a good example in SaaS software. So you've got customer acquisition cost and the lifetime value of the customer. And the key there is to make sure that works, that your CAC, customer acquisition costs, are lower than your lifetime value. So that's a key metric, and you really have to pay attention to that when you start your company all the way to the sale.
Yeah, and what I would add to that, again, going back to ad tech, what you've seen in that type of market is gross margins at some companies being extremely low relative to other companies in the market. So gross margins of some companies being around 20%, really because there was a lot of pass-through revenue that was going on. So a reset in the market to focus on what in essence is that true revenue. Picking up on something that Ben had said, and we agree, there does need to be a path to profitability in these discussions. Not only are buyers thinking about, okay, I'm going to pay X million dollars for an acquisition, but what do I need to pay beyond that acquisition to make this work? What losses do I need to fund? Things of that nature, which makes an acquisition more expensive. They're certainly having those discussions internally.
Yeah, just to add to that, valuation really is from the buyer's perspective. When they buy your company, what are they going to generate in revenue and EBITDA? Because they have a global sales force, so that's their calculation. And you can never quite get in their heads, but it's always helpful to have that discussion.
Let's move away from valuation and talk a little bit about the M&A process itself. What could a company expect to see in terms of some of the things that we will hear about and read about: cash flow earnouts, contingent considerations, warrants, option replacements?
When you talk about purchase price, you gotta ask yourself, what does the purchase price consist of? And there's a lot of things that it could consist of. It could consist of cash, which is easy to understand. Less likely in a tech sector, it could consist of debt. Because a note that they'll pay you later. If it's debt, then you got to ask yourself: is it secured? What are the terms? Is it going to create a present tax for me, even though I don't get the cash up front? More likely, it may well consist of stock. And stock raises all kinds of issues. It raises issues about valuation. If it's a private company, how do you value the stock? If it's a public company, presumably you look at the public metrics. And secondly, it raises the question of how do I liquefy that stock? How do I get liquidity for that stock? Can I sell the stock? And there's multiple issues there that arise. There are limitations under the security laws, insider trading, 144 if it's private stock. There could be contractual restrictions on your ability to sell the shares, voting agreements, right of first refusal agreements. There may be practical limitations on your ability to sell. There may not be enough of a market for you to sell the shares. So, the stock raises all kinds of issues. And the final piece is earnout, and the other bankers will talk a little bit about that as well. I mean, earnout is the least valuable type of consideration because it's contingent. It's basically saying, I will pay you a some set of money if certain things work out. If the technology you transfer to me works, if the business you transfer me meets particular metrics. And as Ben and Todd will tell you, it's a great way when there's not a meeting of the mind between the buyer and the seller on purchase price. It's a great way to increase the size of the purchase price because you can make it contingent upon future events. Problem with earnouts, and as those guys who know me, I'm involved in an arbitration right now with an earnout. The problem with earnout, it's very hard to compare apples to apples, oranges to oranges. And once you sell your business to somebody else, how are you going to monitor? How are you going to police that they're going to put in adequate resources to market your product and adequate resources to develop your product? How do you compare that on an apples to apples basis unless you completely keep your company separate and frozen in time? So it's earnouts are give you big numbers, more difficult to enforce. Ask me, I'm involved in an arbitration right now.
No, I think that's right. The starting point when it comes to our earnout, at least on our side, is largely no, and that's not a discussion that we're having. Sometimes the discussion is brought there based on trying to bridge this potential value gap. But the real issue in terms of the earnout is the lack of control, as Conrad's alluding to. Is it a revenue-based earnout? Is it a profit-based earnout? Is it a milestone-based earnout? On the revenue side, are they going to put budget against it? I mean, in one extreme example, they could theoretically remove the entire sales force and then there's no revenue to drive that earnout. It comes down to definitions. If it's a technology business and they're integrating your technology into their technology, if they sell that integrated product, whose revenue is that? How is that defined? So a lot of questions. Even more questions on the cost side, okay? What are allocations for corporate? Things of that nature. So when we do earnouts, we'll try and make it milestone based in terms of product development or transition of employees. Very tangible, very specific things that you can understand and identify. The ability to control and identify them would be the important factors.
Yeah, I agree with Todd. It's earnouts are tricky to measure. That's the key thing. Can you actually measure the revenue, the milestones, the EBITDA? That's very, very difficult. One thing I'd like to point out we're seeing, it's interesting, is we're getting some companies coming to us from Silicon Valley, and they're having a hard time raising their C round of financing. They raised the A, they raised the B, and now growth's slowing. They're still growing, and they're coming back to us saying, hey, last round was 150 million valuation, and now we do the valuation in the M&A market, they're worth 100 million. So, 150 to 100. So what do you do then? It's a down round. And the thing to be cognizant of is your cap table and how it's structured. Because we see, actually, it's difficult for the founders sometimes because they get wiped out by the preference at the top. So the B round get preferences, and there's nothing left for everybody else. So for the first time, we're seeing actually management carve-outs where, in the cap table, they're guaranteed 25 million on the sale no matter what. So they're at the top of the pyramid in terms of preferences.
Just real quickly on earnouts, which you all touched on. How often do you see it? I mean, is it 10%, 50%, 90%? Just kind of give us a feel.
Yeah, it's probably 40% of our deals. Just to bridge the gap. We just did one with an earnout. And the key with earnouts for both sides is to be very conservative. Founders make these projections that look wonderful on paper, and then if you don't hit them in the first year, people walk away. And that's not good for the buyer either, because they're buying the team. So you just basically cut in half the projections, you get something for the conservative, and then if you hit the projections, great, you get more.
On our side, it's a fairly low number in terms of 5-10% of deals that will have an earnout, and I think the driver to that, or what helps in that, is competition, right? So what we'll try and use is a buyer puts forward a number, so I'm going to pay you, X, and if that becomes an earnout, it's X plus 20. At that point, we have X plus 20 that we're shopping around to try and bring in a competitor at that headline price. Okay, so we're trying to use that really as negotiation leverage with a broader buyer group. Okay, and then as Conrad alluded to, it's the riskiest form of consideration that you have. So if you're able to increase consideration or part consideration even by a little bit, that could be more attractive than an earnout. So that's really how we've started to think about it.
You know, there's an inverse relationship between leverage and earnout. The least leverage, the least bargaining power you have, the more likely you're going to get stuck with an earnout. When we sold AE Polysilicon, the solar company that I was at 3 years ago, we were out of money. The Chinese buyer knew we were out of money. We didn't have a lot of options. So 60% of the purchase price in that deal was structured as an earnout. You know, we had built a reactor to produce polysilicon using fluidized bed reactor technology. The earnout with the Chinese was if they could make the reactor work, they would pay us a certain sum of money. Well, you know, they went and they built a slightly different reactor. We think largely based on what we told them, but they came back and said, well, we built a different reactor, so we don't owe you the earnout. And it shows to you the complexities you get into when you have a lot, when you lack the leverage and you get into the earnout negotiation.
On another aspect of the M&A process, we're all familiar with due diligence as one of the key phases, and a closing, which everyone hopes to get to. Talk a little bit about the process leading to due diligence, anything that, you know, kind of key steps that happens in between leading to a successful close.
Yeah, sure. So it's basically a staged process. Initially you have a blind profile to see if they're interested, to keep the company's name anonymous. And then you have a confidential information memorandum, pretty thick document with a lot of other info. And then you have initial due diligence, preliminary due diligence, to make an offer. And then after the offer's in and you accept that offer, it's intense due diligence. Just be prepared. We had one client in Switzerland, and relatively small company, 10 million in revenue, and the buyer was a big billion-dollar market cap company, and he had 10 accountants in his office one day, pouring over his books. So just be prepared for that. Really intense process.
The one thing I would add to that, just to think about, is where you have the most leverage is that pre-LOI phase, okay? Theoretically, you're talking to multiple buyers, you're negotiating with multiple buyers, and once you typically go exclusive beyond that point, the leverage shifts immediately to the buyer, okay? But we work on the buy side as well, and on the buy side, we'll often try to get to LOI really as quickly as possible, okay, to avoid that competition, take that off the table. Once they go exclusive, then the time and energy required to support that lengthy diligence process really transitions all that leverage to the buyer. They're able to understand and watch the financial performance of the company, and all of that I think drives how they behave.
Yeah, so that's a critical point, guys. When you first come to your deal, you're going to send it forward in a term sheet or a letter of intent. A letter of intent, the term sheet is generally not binding except for one provision, as Todd points out, which is called the no shop or the exclusivity. And the no shop says that you can't shop your company for a period of time following the letter of intent being signed during this negotiation period. And as Todd points out, guess what happens when you give away your walkaway card? Your leverage now has dropped dramatically. Not only can you not talk to other buyers, but the buyer is going to be doing forensic accounting and legal due diligence, pouring over everything you do, and you're going to be in a situation where you're going to be trying to manage your workforce, customers, competitors while you're in play. Very difficult situation. So all these issues we talked about before, and beyond the purchase price, liquidity of stock if it's a stock deal, details of the earnout if there's an earnout, your compensation, your non-compete, if you're going to be with the company going forward, if you're not going to be with the company going forward. Flesh that out before you give up your walk-away right. Flesh that out, the letter of intent stage.
I just want to add one thing. It's really important to have fairly conservative projections for the next 6 months, because otherwise what happens is you're in the exclusive period, no shop period, and you miss your revenue projections by 10%. And if that happens, the buyer is going to cut your price by 20% because you can't project very well.
And remember, guys, if it's a publicly announced deal, so they probably, in some cases, a public company will publicly announce at the letter of intent stage, think about what that's going to do to your performance. Now your competitors, your customers are going to stop paying because they don't know what's going to happen. Your employees are going to freak out because they don't know whether they're going to be retained. Your competitors are going to try to pick up, off your customers. You know, when you factor in your performance, and you factor in with the potential impact of the public announcement.
Let's talk a little bit about negotiating the deal. What I want to ask each of you to comment on, if you could, is one sort of tip that you want to share with the audience as they think about negotiating, and one pitfall to avoid.
Yeah, I think the key thing for negotiation is competition. You know, it's a process. If you get approached by one buyer, you should immediately start thinking about getting other buyers at the table. Otherwise, you have no leverage at all. So that's really key. Pitfalls, I would say, really, it's the due diligence process. Just make sure everything's buttoned up. You know, financials really important, legal is really important. You know, I've seen cases where they're missing a shareholder, right, that owns 10%, and they need 100% to approve the deal. So just make sure you look at your cap table, make sure everything's buttoned up before you go into that process.
What I would say is, for the most part, exit transactions don't just come about, right? You're thinking about where you are in the life cycle of your business, what that exit may look like, where you want it to be, when the timing is right, where financial performance is. So there's usually a runway and a lot of work that actually goes into in advance of that exit transaction. So in terms of creating leverage, creating value, competition is certainly the key. One of the things that we like to see that will work with clients really way in advance of a transaction is to build out that buyer group. We almost call it educating that buyer group, or building that partner ecosystem of companies that know your company well. So you have that internal champion at those buyers, and then they can react quickly and build value in that way. So really prepping for that exit transaction by, in essence, building that buyer community, we think is really a very important point. Equally as important as you're thinking about a sale is having your own house in order. So there's a shareholder perspective. The other thing on the technology side that's very key is on the IP perspective. So have you used outsourced developers? Have they all signed waivers? Who owns the IP? If you've spun out the company from a different business, is the right documentation in place? If you're using open source, are you using open source correctly? Are you paying royalties? So really getting your IP house in order is vital. If you're dealing with large strategics like an Oracle or Cisco or any of these companies, they won't touch an IP issue, right? Because their IP is so sacred, literally they're legal to shut down a deal no matter how strategic it is if those types of issues exist.
Guys, you sellers out there, clean up your messes. There's one thing you take away from this presentation is that in the vast majority of circumstances, the seller has more leverage than you. He's got more resources, he has more knowledge. There's more risk that he's going to walk away. So as Todd pointed out, as Ben pointed out, if there are issues outstanding, if there are disputes among founders, if you have disputes with former technology providers, with customers, with licensors, buyers don't want to buy into a mess. You deal with them. You know, it's not personal, it's business. I had a lady call me a couple of months ago to tell me, you know, one of her key developers had left and he was going to steal the business and steal the technology, and she wanted to get an injunction and she wanted to sue. And I said to her, you know, you're in the process of raising money and potentially selling the company. How is it going to look with the public litigation on file that calls into question the chain of title to your technology, that may suggest that some guy stole it? Cut a deal with them. It's not personal. And the other thing I would say is there's going to be some messes you can't clean up. There's going to be some skeletons in your closet. Don't hide the skeletons. Buyer's going to figure it out. He's going to conduct due diligence. He's going to ask for reps and warranties. You're going to have to disclose them. And when they come out, you're going to lose all your credibility. When you have issues, manage them, spin them, volunteer them, go to the buyer and say, here's my issues, this is how I manage them. When we sold AEP, we had a problem with the original licensor of the technology. We thought that it was junk, we didn't use it, we were in a dispute with them. So we proactively went and got an opinion from a lawyer, from a global law firm telling us that freedom to operate opinion, that we didn't in fact use that technology. So when we went to the buyer, we said, look, we have a dispute with our original licensor, but we don't use this technology, it's a non-issue. We spun the story, we fixed the story. Had they come up with it in due diligence, they would have walked away.
Yeah, just to make one last point on tip. So the M&A, mergers and acquisitions, is a market, right? You have supply and demand. And right now, demand is very heavy for companies, which is great. But just one tip, look at your competitors. Everybody has competition. Just put that on the table, right? Remember that one, Todd? It's like, we have no competition. Everybody's competition. So, say you have 5 companies in a sub-sector, and you're monitoring the news every day like you should about your competition, and one company gets sold to IBM. 2 months later, second one gets sold to Microsoft. Now you have 3 left, right? And you have 2 less buyers. So valuations tend to go down. The first buyer gets the most, and it takes 6 months to do a deal. So if you're the 5th one getting sold, you have much less buyers out there, and your valuation will go down. So monitor the M&A market in your subsector.
I was going to ask a bunch of questions relating to the anatomy of the deal process. I think we've covered a lot of it, but let me just throw it out to the panel. Is there anything more that you want to share with the audience regarding the anatomy of the deal that we have not covered?
Yeah, I guess the one point is valuation. Just make sure you have a very thorough valuation model on your company. You're looking at precedent transactions, other M&A transactions in your sector, and comparable companies, public companies. Make sure it's really, you can defend that model fiercely, because that's going to come up in the valuation discussions, and it matters.
And I guess what I would add is, not only do you want to be prepped for the process going in, because once you start to have those discussions with buyers, things move very quickly. So before you actually get into those deal discussions, you want to have your documentation, you want to have your financials, you want to have your data room really in order so that you can seamlessly support those discussions. So that from the buyer perspective, again, they're all trying to figure out, are you talking to multiple people? Where are you in the process? Am I the only one in this process? So for those buyers, you must have a competitive dynamic that they're seeing, and the way to do that is to move them seamlessly through so that when they ask you a few questions, you don't have to go back for 3 weeks and try and develop that information. You have that information because you're giving it to 10 other people, right? So it's really about that preparation in advance of the process that allows you to move effectively through the M&A process.
Yeah, like Todd is saying, if you're a seller, your most significant negotiating asset is your goodwill, it's your credibility. If you've got credibility, if you've got goodwill, you have respect, and if you have respect, you have leverage at the bargaining table. So you want to present the professional profile. There are lots of cool tools out there. There's Box and Merrill, there's virtual data rooms. As Todd points out, get your documents up there. Make sure they're not in default. Make sure that your cap table reconciles with the reality. Make sure your financial statements conform or at least translate them to GAAP. Have those. When I'm hired by a buyer, which I often am to do due diligence, and I find that their house isn't in order, their papers are crap, their cap table doesn't reconcile, I come to 2 conclusions. One, I'm not going to believe a one word these guys ever tell me. They have no credibility with me. Secondly, I'm going to conclude that they're amateurs, and I'm going to run circles around them in the negotiating table. So, but if on the other hand, if I have a clean set of documents, I'll probably stop even reviewing them after a while. I'll just trust the opposing side that they've done it right. It gives a lot of credibility to the seller.
In the due diligence process, are buyers looking at all privacy and security issues of the company they're going to acquire?
So the short answer is yes.
On a scale of 1 to 5.
It really depends on the business. Okay, so certain data heavy businesses where do you have the rights to that data? Are you using the right privacy guards? So you'll see that a lot in internet. You'll see that a lot in social networks. So a company like Facebook is in the press every day in terms of their privacy issues and approach. So when they look to buy or acquire a business, that's certainly front of mind for them. So I think that it is certainly important. It's more important depending on the market that you're in and the buyer that you're talking to. I guess the other thing is you'll be able to figure that out in advance. So if you're talking to Facebook, you'll know what are their hot buttons, right? You'll think about that in advance, and you'll be able to position around that.
Yeah, it's particularly important in digital media deals. Like, do you own the content? That's the key question. Or the rights to the music, or the rights to the library. So it's really important to have an outside opinion on that. That's very helpful. Typically a legal opinion that you do own those rights.
The question I had is the point about the debt to equity rate, whether or not it's public or private, or the issue of chargebacks, that customers bought the product and said, well, they didn't like it and returned it. And that's what I'm saying, before a person sells the company, before the person buys the company, they're looking and they see that there are chargebacks. Credit card chargebacks.
Okay, so we've seen issues like that around e-commerce type transactions, where there'll be returns or chargebacks or things of that nature. It really factors a lot into working capital, okay, and how large those are. Again, it's really about exposure and managing risk. There's norms that you've had, so buyers in part of their diligence are looking at historically what have those chargebacks been. They're going to be talking to you for 1, 2, 3+ months during the diligence phase. Are they changing? Where does that look? And then they'll be looking to protect themselves, whether it be through that working capital adjustment that Ben alluded to, or future reps and warranties saying if there's an outsized number of chargebacks, in essence they'll be made whole. So it's part of that negotiation. Certain businesses have that as a more prevalent issue than others.
Yeah, I think the key thing there is buyers like looking at trends, right? So that's why you have 3-year historical financials and 3-year forecasts. They like to see that because then they can look at trends. And I'll give you an example of chargebacks or customer retention. If all of a sudden your customer retention's falling off the cliff, something's wrong. And they're probably not going to buy your business. If it's consistent, that's great. But that's what they're looking at, is the trend analysis.
Hi, I have a question. If the company is bootstrapped by, let's say, 2 founders versus the company that already has like an investment banker or a VC, is there a difference in the M&A process?
Not really. It's a similar M&A process. Now, I think a lot of buyers actually prefer founder-owned businesses, okay? Because when you bring in venture investors, not the bankers per se, but the venture investors bring in a whole other level of complexity, okay? They have returns analysis. So in the case of certain venture instances, perhaps it's a transaction that doesn't meet their return thresholds, whereas you, a founder, may be attracted to that. So I think buyers almost prefer that. Now, that said, bringing in a venture capital firm, a round of investment, usually in some ways professionalizes the business. So you would have gone through that venture diligence phase. You probably have a data room. You have a stamp of approval of somebody that's willing to invest in your business, having done that diligence. So there is a comfort level. You also potentially would have a sort of a more formal board process, and you call it management report process. So there are those pluses and minuses, but in terms of the day-to-day process, no, I don't think it changes that much.
Well, the only thing that changes is the board approval process, right? Because VCs, venture capital firms, typically have a few seats in the board, and as Todd was alluding to, basically the valuation metrics they want are probably different than what you want. You'd be happy with 20 million, but they want to get a 10x return, they want to sell it at 40 million. And that can get tricky. So it's really board negotiations. And the key there is if you have a VC firm on board, look at the board, look at the articles of incorporation. What does it take to approve a merger? Is it 75%? Is it 50%? Just be really cognizant of what your rights are within the articles. Correct, Conrad?
Yeah, of course. And look, if buyer is interested in the founder's continued service or continued support, they're going to much rather have that consideration go to the founders than to go out the door to some financial guys they're never going to deal with again. So in a lot of ways, as Todd points out, in a lot of instances, they would rather deal directly with, they would rather equitize and enrich founders who are useful to them than financial players who are just gaming them.
And one point I would add is, I do think in the case of founders, it's almost more important to have a banker or certainly a type of legal intermediary, because one thing that you have in a venture-backed business is you have the board, right? You always have the ability to pivot back to the board. And it allows you to bifurcate that discussion, and you can talk about certain issues, but hey, I have to run it by the board. If you own 100% of the business or 50% of the business, you are the decision maker. You don't have the ability to, oh, let me go think about it. It's sort of yes or no. That's why having a buffer between you and that discussion allows that buffer to push it as far as it wants, and then I have to go check with the owners of the business, and then I'll come back to you. So I think in that case, the intermediary is almost more important.
And I sold one business, and the founder owned 99% of the stock. And he goes, I found this one precedent transaction, 14 times revenue. And the average was 5 times revenue. He goes, I want 14. I go, I'll put whatever number you want on the table. The guy sold the business for 14 times revenue. Would VCs take that risk? No. It's his business. He can do what he wants.
What's the difference between the types of business you're talking about, which seem to be software, and manufacturing?
So at Mooreland, we do work a lot with software, but we also do have an industrial technology team that works a fair amount in manufacturing. That's not my specific expertise. I do see that profitability is actually the key driver in those businesses. And we are seeing obviously outsourcing and what that looks like being increasingly important. But in that case, it's valuation largely driven by profitability. We're also seeing generally market conditions there being slightly more challenging. So different types of valuations there.
Is it a different selling process, M&A process for manufacturing?
No, it's a different set. It's certainly a different set of buyers. Seeing a lot more buyers from the Asia Pacific region, perhaps different parts of America. So a different buyer group. Process largely remains the same. We're seeing some smaller buyer groups, because it's a lot more consolidation that are going on in those industries. But again, in terms of process, I think Ben outlined it fairly well. It is that typical process. In terms of reps and warranties, environmental becomes a lot more important. On the software side, that's a non-issue.
So it's mainly the buyers that are different.
I think buyers' valuation would be big differences there.
Well, look, it becomes a different process, because now you have to look at the balance sheet comes into play. So now you got to look at hard assets, you've got to look at real estate, you've got to look at labor, you've got to look at environment, and now instead of having a working capital adjustment, you're going to have a balance sheet adjustment where they're going to look at the long-term assets as well. So I mean, it's the same animal, but there's different points of emphasis.
Different orientation.
That's right.